Thanks, Mario. It's a pleasure to be here. It's a pleasure to be back at this conference. It seems to be something that every speaker says, that I've been coming to this conference for a long time, etc. But I think I have not been here for a very long time. And I think last time I was in this conference, it was done in another hotel downtown that no longer exists. So it's great to be back. And I think, as always, it has been a very insightful conference on monetary policy. And I think, as somebody said, the reference for Latin American financial policymakers for a very long time. And thanks to Michael for writing a very comprehensive paper that goes in depth into many issues and really covers a lot of ground regarding monetary policy in emerging markets in the last 20 years. I would like to focus a little bit more on the experience of Latin America with respect to monetary policy and central banking after the global financial crisis, and then focus on some more specific comments on the paper. I think, a little bit before the global financial crisis, as Michael's story starts, obviously Latin America took much longer to converge to low inflation and to a stable financial setup. And I would say that when the global financial crisis hit, Latin America was in a pretty good position. At the end of the day, given past crises, it had put its fiscal situation in order, also with the help of significantly high commodity prices. It had put its financial system in order, I would say, as a product of destroying it in the past, but after destroying it, setting up a pretty solid regulatory framework, and really putting a lot of focus on prudential regulation and not falling prey of the financial innovation craze of the early 2000s. So I think a lot of the issues that hit advanced economies were not generated vulnerabilities for Latin American economies. As the paper says, in Eastern Europe, there were more problems related to funding of local branches of Western European banks that generated significant source of contagion. And in Latin America, even when you had a significant presence of foreign banks, you have a subsidiary model that, on top of being a subsidiary model, it was almost 100% locally funded. So in that sense, the sources of contagion came a little bit more through the cost of capital, etc., but there were much less direct links to the source of the problem in advanced economies. Second, as the paper says, with respect to trade links, many South American countries were much more linked to the commodity cycle and therefore to the China cycle than to the US and Western Europe business cycle, except the case of Mexico, that was the country that suffered the most during the global financial crisis, or that it had the deepest recession during 2009 and 10. I would say that the most direct source of contagion that also hit some Asian economies were basically significant derivative positions of major corporates in Latin America and in Asia, that when the global financial crisis hit, when we had a flight to quality in capital flows, exchange rates depreciated, and a lot of these derivative positions generated significant capital losses to an important number of corporates in Latin America, for which governments had to put some kind of credit lines, FX intervention, etc. I would say that was the major source of financial contagion. And as I said before, the countries that were most hit through trade links to the US, like the case of Mexico, and significantly less so the case of Colombia, given their good fundamentals, ended up negotiating flexible credit lines, contingent credit lines with the IMF to complement the international reserves that they have accumulated in the past, to provide significant liquidity, basically to be able to withstand the significant drop in capital in capital flows. In addition to that, it was the first time around that Latin America was able to implement counter-cyclical policies, both fiscal and monetary. And for many countries, especially those in South America, the huge Chinese counter-cyclical fiscal expansion represented a very important policy for Latin American countries to piggyback on, given the effect that it had on commodity prices. So you had a very sharp rebound of commodity prices, on the back of which the business cycle in Latin America came back up pretty quickly. From the central bank, therefore, from the central bank viewpoint, I think my recollection is that there wasn't a lot of rethink. I mean, at the end of the day, this big shock actually generated a significant sense of relief that the things that had been done in the past actually worked, and worked quite well. So you had, the flexible exchange rate worked extremely well. It isolated this economy significantly from the shocks. The financial regulation worked well because major banks did not experience significant problems. And these economies were back at positive growth in 2010, and some of them at pretty high rates of growth. I would say that the most important policy lesson that was incorporated and developed in Latin America after the global financial crisis was the introduction of financial stability committees. Basically, there had been a lot of focus on prudential regulation, but obviously not on macro-prudential regulation, and therefore the creation of financial stability committees here in Chile, in Mexico, in Brazil, etc., was an important complement, basically, to look at the macro-prudential aspects and complementing monetary policy as one of the main objectives of central banks. I would say a very clear example that this system has worked. If we look at all the shocks that, the major inflation targeting countries in Latin America, Chile, Colombia, Peru, Mexico, Brazil, have suffered since the global financial crisis, itself, then the taper tantrum in 2013, then the declining commodity prices starting in 13-14 for metals and 14-15 for oil, and then important trade policy uncertainty at the global level, starting with the presidential campaign in the U.S. and then continuing with the change in approach to trade policy in the U.S. Countries have been able to maintain a low inflation relatively within the inflation targets, a stable financial system, and to administer a business cycle that looked much more like the small open advanced economies like Canada, New Zealand, etc., than the traditional Latin America boom and bust cycle. If you look at the case of Colombia, the governor is here with us, Colombia lost 6% of GDP in foreign income with the price of oil drop, and maybe growth went from 4% to 2%, and after 2-3 years it went back to 3.5%, where it is today. The exchange rate depreciated by 75% in nominal terms from peak to trough. Inflation maybe went all the way up to 9% and then quickly came back down. And the economy was back in growth after 2 or 3 years. So I would say, just repeat that as a lesson, I think it was the largest stress test that these economies could be subject to, and they passed them with flying colors. And in that sense, I think there wasn't a lot of rethinking. It was more, let's continue to converge to what used to be the gold standard of central banking before the global financial crisis. And so far, let other countries experiment, and if there's another wave of catch-up to do in the next decade, we will wait and see what other central banks do, but this is working for us, so we will keep the systems that we have. I think in terms of the paper per se, I think, I think the point that I like the most about the paper is introducing this, let's say, broader governance discussion together with the central bank independence and central bank transparency. And starting a discussion that I think is, it would be good to see develop even further in another paper on how in countries in which central bank independence and transparency continues to deepen, how monetary policy is being affected by broader governance declining. So in a sense, countries in which we're seeing an assault on institutions that has not yet affected the central bank, I'm pretty sure central banks are internalizing that threat, and therefore for monetary policy is being affected even now by that global weakening of institutions, and is putting also central bank independence at risk for the future. So I think that point, at least, is a point that I have not seen as clearly structured as it is in this paper, and I think it warrants even a deeper discussion, because I think it's a challenge that central bank authorities will face in the next decade, to the extent that we continue to see this institutional deterioration taking place in more and more economies in the next few years. With respect to the resilience indicator, I was a little bit skeptical, in the sense that I don't know exactly which components are the ones that are deteriorating the indicator. If are the components that touch upon general governance indicators, I would fully agree. If there are the components like the FX regime, for example, I would say that what we have seen after the global financial crisis, at least in the Latin American experience, maybe central banks complementing the interest rate with other instruments. I mean, central banks have intervened a little bit more. I mean, that has not been the case in Chile so much, but when you look to Colombia, to Mexico, to Brazil, so they have complemented with FXI, and they have complemented the interest rate in the case of Asia with CFMs as well. To what extent this is a weakening of governance, I don't know. I think it's a valid discussion to see to what extent in economies that have not an extensively developed financial system complementing monetary policy with these instruments under severe shocks, it's positive. And even more than that, I don't know, it's a weakening of governance. Maybe those tools were already in the toolbox. The only thing, they were not being used because the shocks were not large enough. But in a sense, it's the same governance. The only thing, it's an observational problem that before, given the shocks were small, with one instrument they were doing fine, but there's some kind of non-linear effect, and for larger shocks you need to use all the tools in the toolkit. With respect to the measure of central bank credibility, and I see that my time is running short, I see the challenge of trying to adapt the de jure and the de facto measures. The de facto measures in many cases, I mean, even people say that the current charter of the Central Bank of Argentina gives the Argentinian Central Bank independence, no? And it has changed the central bank governor, I think, 4 times in the last 3 years or 4 years. So I think it's totally right that we need to look for other measures, but to the extent that you construct a measure with endogenous variables, to what extent we're not measuring things that are hitting the system and generating transitory inflationary spikes that then correct themselves, affect in a transitory way inflation expectations, and it's not so much the credibility of the system per se, but it's basically the external shocks that are hitting the system. And I think, I mean, it's a challenge that these measures will have to continue to address, to the extent that you have inflation expectations for longer horizons that should be less affected by current shocks. I think it would be better, but I gather when you go and try to do it for a large sample of countries, it becomes harder to do. And I think in that same line of reasoning, in your VARs, and when you look at the effect of some shocks on credibility, I think maybe it would be interesting to see a deeper discussion that to what extent is actually credibility, or to what extent is basically a non-linear response of inflation. Like credibility basically is counting for large inflation shocks, given that you have the square term in your credibility measure. No, that was a doubt that I had, and I would like to ask you as well. You have this puzzling result that advanced economies, when interest rates go up, credibility goes down, and in emerging markets you have the right result. When interest rates go up, credibility goes up. And I was thinking to what extent we're not seeing some kind of asymmetric response to increases and reductions in interest rates, or shadow interest rates, especially when you're close to the zero lower bound. So to that extent, when you are in the advanced economies case, We have seen for a long period of time central banks reducing interest rates or shadow interest rates, but not enough to actually bring inflation expectations up. And therefore, what we're seeing is the central bank trying to stabilize the economy, but it's always behind the curve. No? So it continues to reduce interest rates, but inflation expectations continue to, or deflation expectations continue to deteriorate, and it's a little bit the trap that we're in. And just to close, I would urge the readers to also go through the appendix and the country cases. I think there's a lot of interesting description of what was done by these countries during the global financial crisis, and I think there are important questions there on how not so much CFMs, but FXI complements or not, or actually undermines transparency of monetary policy. And I think those are questions for central banks in Latin America for the future, how to better integrate, if they want to do it, FXI into their framework, because if it's an important and effective additional policy tool, that I think it's an important question to answer before doing it. But if we're going to do it, I think it has to be communicated in a way that at least tries to achieve the levels of transparency and communication that the interest rate instrument has achieved. So far, we have used it a lot in the case of Mexico, in the case of Brazil, in the case of Peru, I think with a significantly lower level of transparency, and I guess in some instances is contributing also to create uncertainty given the different quality of the framework under which these operations are being undertaken. Thanks.